Hello everyone, welcome to the Gold Line Show. First up, I want to apologize because during the live stream, I had an issue with recording, so the entire audio is not usable. So I cannot upload the live stream we had, which is okay. It was the first live stream that I had this year, and most people were watching through TikTok anyways, and people seemed kind of confused about it. But anyways, that's why I'm doing this video right now, to just recap what we were and go over what we were talking about on the live chat. So people are afraid of recessions. They don't understand interest rates, and many people who read my book and read my blog are a little bit confused about my strategy, sector rotation. And so in this video, I want to show you how you use a sector rotation strategy, and more importantly, how you determine the phase of the economy, which is very important for sector rotation, to determine where to put in your investments with this strategy. So in my book, I have a nice little chart here that I want to show you. So this one right here. So sector rotation, what is it? Well, the economy and the stock market move in a cycle, which is called the business cycle. You might have heard it in school. So the economical cycle or business cycle has two phases, which are the expansion phase, or better known as the bull market, and then the deflationary phase, which is best known as the bear market. So the bull market is the expansion and boom phase, and the bear market is the recession and depression phase. So I call it expansion, boom, recession, and depression. And this cycle happens in about 4 to 7 years. Before 2020, we had a 10-year bull market, but it's usually about 4 to 7 years. So it's a long game. So sector rotation strategy is long-term investing. So here I called it expansion, boom, recession, depression, but I also like, and I mentioned this in my book, to use the seasons as a metaphor for the economical cycle. So the expansion would be spring, the boom would be summer, the recession would be fall, and depression would be winter. I try not to use this metaphor too often in my live streams or on TikTok, because I see that it confuses people, and people think it means the actual seasons in a year. So it has nothing to do with the actual seasons in a year. It's just a metaphor to better understand this cycle. Well, so this is important to understand because different sectors, which we can see here, which I will get into shortly after, perform better historically in different phases of the economy. So right after 2020, after the COVID crash, we had the fastest recovery ever in history, and we were in an expansionary phase. That's where we saw consumer discretionaries, technologies, and communication services going absolutely crazy, which is reflected here in the 200-day moving average. And we can see it right here, actually. Information technology, 90%, communication services, 100%. So those were the best performing sectors, which makes sense. Right after a recession, the best performing sectors are consumer discretionaries, tech, let's just say tech. So how to determine where we are right now? Well, let's have a look at the 50-day and 100-day moving averages. So this would be late December and January. So what can we see here? So let's look at the 100-day moving average, and we can see that the best performing sector was 200-day, 150-day, and 100-day average was energy. The energy sector was doing absolutely great. It performed more than twice as well as the S&P 500 index fund, which I use as a benchmark to measure the economy as a whole. And then the We had financials as the second best performing in the 100-day moving average. And as the third best performing, we had industrials. So basically everything was performing well, but mainly energy. And then we have industrials really high, and consumer discretionary extremely high, and materials really high. So from the 200-day moving average to the 100-day moving averages, we can see that energy, industrials, and materials, not so much, but yeah, materials was performing extremely well. Why is that? So let's have a look at why industrials, energy, materials are performing well, but alongside communication services and consumer discretionary. So mainly information technology, mainly tech sector. So let's look at this graph again. So here we can see that communication services are in the expansion phase, but energy and materials and industrials, especially industrials and energy, perform really well in the boom phase of the economy. So what I use mainly to determine where we are in the economical cycle right now, I use bar chart and look at sector performance. If we go to most recent events, so for 5-day, 20-day, and 50-day moving averages, we can see that industrials is really well performing, and consumer staples is picking up a lot, and energy is slowly tapering down. So this sudden low in energy is because of the Suez Canal blockage, I believe, which is a black swan event. You can't foresee those things. Those can happen, just like the COVID crash, which is also an event that no one can foresee. But we can see that materials slowly tapering down, but still performing well. Industrials performing extremely well and staying up there. And energy also performing extremely well, but just because of the recent events, not so good. So it is energy, industrials, and materials that are performing really, really well. We also have a large movement of financials in the 50-day average and real estate in the 50-day average. And I will tell you why. Because so just looking at the recent movements, we can see that we are somewhere in a boom phase of the economy. But why is finance and real estate up as well? This the depression phase, right? Well, I tell you. So there's one factor missing in this whole sector thing in my book. Not really missing, I just didn't mention it. It's a book for beginners. I didn't want to confuse people too much. But what is missing is interest rates and inflation rates, which are actually playing a equal or maybe even bigger role in the movement of the markets. So just like sectors just like sectors are affected by this market movement, so are interest rates and inflation rates, a good indicator of where we are in the market. So we cannot ignore that. So the sector performance is just half the story. And the other half are interest rates and inflation rates. So in the expansion phase of the economy, when we're just coming out of a recession, we see that the Fed or government wants to stimulate the economy, and they do so with low interest rates and low inflation. And this is what has been happening after the COVID crash. We had low inflation and because of before COVID, and really low interest rates to stimulate the economy. Well, during low interest rates, the two sectors that perform really well are financials and real estate, because it's easier to borrow money, and you want to spend more. So financials and real estate, not so much real estate, but financials especially, are really benefiting from low interest rates because people borrow more. So this is right after the depression, right when we get off the bottom of the depression into an expansion phase. And this explanation why financials and real estate is up together with traditionally with sectors that are traditionally performing well in the boom phase is, in my opinion, just because inflation is up. So interest rates low and inflation low is the expansion phase of the economy. As to stimulate the economy, as it is stimulated and slowly overheating the economy, interest rates stay low, but inflation goes up a lot. And during inflation times, the best industries are industrials, materials, and energy. So the worst place to put your money during high inflation is holding cash. And the best place to put your money is owning equity, followed by real estate, followed by gold. But number one, in my opinion, is still holding equity, especially industrials, materials, and energy. They are benefiting from high inflation. And because of COVID and the lockdowns, we had extremely high inflation during this period. But at the same time, interest rates are very low. And this is why I think, besides industrials, materials, and energy, in the moving averages, the most recent moving averages, we have financials and real estate. That's simply smart money moving away from growth stocks into these sectors right here. So the shift towards a bear market and a recession would be if interest rates are high and inflation is high. So both is high. This is when growth moves to value investments. So you have consumer staples, utilities, and healthcare. So all the necessities will go up. And then the market usually enters a depression or crashes or whatever and comes back up. And then you start again with low interest rates and low inflation. It's a cycle. And it's just as relevant to this cycle as the sector performance here. So this is one part of what I wanted to explain to you, how to determine where we are in the economy based on interest rates, inflation, and sector performance. And in my recent videos, I talk about the yield curve a lot. So I will talk about this real quick and then tell you what I am doing to prepare for this shift from boom to recession. And I will answer some questions that many people have and which are always the same every time I go live. So an inverted yield curve has predicted the past 7 recessions. So the recessions are in these gray areas right here. And every time the yield curve flipped, about 6 to 18 months later, we saw a bottom of a recession in the economy. So a crash and a recession are not the same. A crash are mostly like black swan events and are in the markets. And recessions are mostly used to describe the economy as a whole. We are in a recession right now because of COVID. But the markets are not the economy. So I want you to understand this, and I will repeat it. Markets are not the economy. So the stock market is mainly the expectation of investors and forward-looking, especially forward-looking to the actual economy, which is measured with real GDP and employment rates. So it is mainly what investors or ordinary people are expecting the economy to be. So there is one more thing I want to touch on, and that is, where's the inflation? I get this question quite often. Well, inflation always ends in the consumer markets in the end. But we are in this situation with COVID that everyone is at home, and the money, so people are not investing into stocks for the sake of owning stocks. People invest into stocks to cash out and spend that money elsewhere. Because of the lockdowns, everyone was forced to be at home. So where's the inflation? I can tell you where it is. It is in Amazon, it is in the stock market, and it is in Bitcoin. That's where the inflation is right now. But as when the moment comes that the economy opens up again and trade and everything is more lean and people want to spend, they're going to cash out, and we'll see, in my opinion, large spikes in the commodity sectors of the economy. And that's when you and I and you and everyone will feel the inflation actually in consumer prices, in consumer product prices. So if you go back to the yield curve, so this is how it looks like in a expansion phase, the yield curve. And when it inverts, it looks like this. And an inverted yield curve, all that means is that short-term treasury yields, which you can see up here, up until 10 years, are higher than long-term treasury yields. For example, right here you can see the 30-year yields. And what is kind of surprising is I don't want to call it a magic number, but kind of like a very strong indicator. Every time the 10-year treasury yields went over 2.1%, we saw a major recession after that. So this is updating daily, and I am following this daily. This actually went up since last week. It was 1.67, which you can see here as well, 1.67. And when was that? March. So in the same month, just a few days later, it went up to 1.73. When this goes over 2.1, what I will do is that will be my signal that there is going to be a switch. We can already see people with lots of influence and money moving away from growth stocks to value stocks and pulling their investments. So I am slowly taking profits from energy, industrials, and materials, which have been performing really well and made me a lot of money until now. And I will move those investments towards consumer staples, healthcare, and utilities. Then I will try to, and hold lots of cash, try to sell out on these sectors and try to sell high, and then basically just hold cash until we hit the market bottom. And then I will come back strongly to invest into financials, real estate, and then of course consumer discretionary, technology, and communication services, because it's a cycle. So for me, the signal would be large movements in the 5 and 20-day averages towards consumer staples, which we can see already here. You see the 100-day average compared to most recent averages. And utilities especially, which we can also see kind of increased in the past 20 days and the 5-day averages. I wouldn't say it's a shift away from energy. I'm kind of curious about what energy will do after the Suez Canal issue has been solved, because I think that is the reason why this is so low. But I need some more information on that. And a good rule of thumb is, if you don't know what the markets are doing, which is kind of what is happening right now, is the best thing you can do is to put your money simply in an S&P 500 index fund and let it ride until the market figured out what it is doing, and then you can deploy again and come back. But at the same time, we have high inflation, and at high inflation rates, holding cash is not a really good idea. So what I will be doing is I'll be waiting it out, slowly put my investments towards staples, utilities, and some healthcare. About 10% of my portfolio is in real estate, and I will cash out high, add to the cash that I'm holding that is already high, and then come back strongly in the expansion phase after we hit the market bottom into financials, real estate, consumer staples, technology, and communication services. So yeah, I hope this kind of explains a little bit better how you do sector rotation. and how it works. And also one thing I want to mention, so sector rotation, I only suggest you to do it in a tax-deferred account. If you're from Canada, there would be a tax-free savings account. If you're from the US, you can use your Roth IRA to do so, where there is no taxes or short-term capital gains taxes that you have to pay, and where you can trade as long as you don't trade too frequently. So the tax revenue agency determines your trading as a business activity. But the reason is, if you use a margin account or just a standard account and you do sector rotation, the short-term capital gains will just eat all the benefits that you are getting from sector rotation, and it's frankly not worth it. It's just better to have a well-diversified portfolio, which you can see on Vinny.com. I have a Vanguard index fund only portfolio there, which you can follow, or simply an S&P 500 index fund. If you simply invest in dollar cost average into an S&P 500 index fund every month, you will perform better than 90% of investors. Sector rotation strategy is a strategy that you can use to get more benefits from that. But if you do not beat the market with your strategy, you have to change your strategy, and frankly, you might be better off simply investing into a large, low-fee US index fund. So I hope that cleared up a little bit. And if you have any questions, you can always DM me and email me. And thank you for listening. Be smart and take care.